Jeni Browne. Welcome to MFB News. I hope you are all doing really well. I started off preparing today's content thinking, God, it's really quiet at the moment. What am I going to talk to you about? Turns out there's loads of stuff actually. So not to fear, we've got lots of exciting news for you. And so what does that look like? So we're going to do our usual roundup on swaps and lender pricing changes. We're then going to be talking about a couple of really interesting pieces of lending criteria change, one of which entails a new lender lending in the limited company space, which is really exciting. We always love a big bit of lending change. It always really sort of shakes the market a little bit, and so let's see what kind of falls out of the tree afterwards. And then lastly, we're going to have a little look at whether the housing market is moving into recovery mode. So lots of good stuff for us to go through today. Okay, so kicking things off with swap rates, and actually it's the same kind of news as it has been for the last few weeks. Nothing's really moving, and as we talked about in last week's video, there isn't any real reason for things to move at the moment. But let's look at what they're doing anyway. So 2-year swaps are at 3.65, 1 month ago 3.59, and 1 year ago 4.26. So actually comparatively month on month we're in a slightly worse position. Year on year we're still we've got our head above the water there. Same sort of story on 5 years. So as of last night 3.73, 1 month ago 3.68, and 1 year ago 3.78. So actually year on year we're practically at the same level, slightly ahead of the game. Compared to 1 month ago, 5 year swaps have risen slightly. So what does this actually mean for lenders? It means their cost of funds month on month has increased a little tiny bit. Are we seeing lenders repricing upwards? We'll come on to more of that in a moment, but the short answer is no. We are seeing a couple of lenders having to increase rates by sort of 0.1%, but actually the general direction of repricing at the moment is downwards. I think probably more to do with the timing issue than anything else in terms of when lenders are releasing their product sets, rather than in relation to this slight uptick in swap rates. Are we expecting swap rates to change much in the next sort of few weeks? No. A shock change at the Bank of England, and a shock change at the Bank of England meeting would either be base rate comes down by 0.5% or base rate goes up by 0.25%. But the markets have already really priced in either no change or reduction of 0.25%. So assuming one of those two things happen, which is obviously very likely, we're not going to see swap rates do anything dramatically different. Other things looming on the horizon which could impact things, the tariffs. There's lots of chats going on between Donald Trump and various countries. We saw he signed a trade deal with the EU earlier this week. This all kind of feeds into swap rates as well, so it'd be interesting to see how that goes. And then we've got the usual kind of inflation, employment data, all that kind of stuff. So we'll keep you posted, but at the moment things are very steady. Okay, so because lenders' cost of funds haven't really changed, it's no great surprise that we're not seeing lots of pricing changes. Also, we're in the middle of the summer, and actually what lenders don't like doing is making lots of changes. If you imagine, I'd suggest that probably at any one time during the summer holidays, at least 10 to 15% of any business's workforce is on holiday. So what you don't want to do is create large bits of work which you're then not going to be able to kind of deliver on or manage, you know, the kind of effect or impact of. So it will be quite quiet over the summer holidays. Things tend to start get going in August, like I mentioned last week. The first couple of weeks of the summer holidays are always the quietest of the year, quieter than Christmas. So actually we will find that as we move into August, things will probably start to gain a bit of momentum. Having said all of that, we have seen some lenders change their prices in the last week, and thankfully all downwards. So first of all, we've seen the Yorkshire Building Society, the commercial arm of the Yorkshire Building Society, bring their rates down by 0.05%. We'll chat a bit about the lenders because there aren't that many of them this week. So YBS are a commercial lender. Really nice group of people to work with. When you take a mortgage with these guys, you get a lending manager, essentially an underwriter, and they're really good. They pick up your file and they look at the whole thing and really underwrite it on a very commercial basis. So realistically, how safe is it for us to lend to this person, both in terms of their ability to pay us and if it all goes horribly wrong to get our money back. No computer decisioning here with these guys, which actually at a time when we're moving into a very kind of tech orientated lending world, particularly with AI becoming ever more present, actually retaining those lenders who are very, very happy to let humans look at applications and use their vast experience and knowledge to make decisions is a really, really good thing. We kind of need both. We need AI, we need computers, but we also want people lending as well. So back to YBS and what they do. So where we at MFB use them a lot would be limited company lending. They can do all the obvious stuff, so blocks of flats, HMOs. They're really looking at larger deals, so I think their sweet spot realistically is between borrowing of 750 and probably sort of £2 to £3 million. That's kind of where they're really strong. That's quite nice because a lot of lenders don't want those bigger deals. They start to really restrict things at anything over sort of £500,000, 750,000. Other things YBS are great at, so they can do trading companies as well as limited companies. Incidentally, they're not lending to individuals. They have, so YBS are part of the Yorkshire Building Society. They have a different lender called Mortgages who do buy-to-lets for individuals, so they're not doing those. They can do complicated ownership structures. They can also do semi-commercial investment and commercial investment and owner-occupier as well. So lots of good stuff with these guys. Now we've also seen Capital Home Loans bring their rates down but up to 0.4%, which is quite interesting. So Capital Home Loans are a specialist lender. They've been around, they used to be around a really long time ago. Then after the credit crisis, they kind of went away, but they kind of reformed a few years ago. And they're a very good lender. They're quite nichey, but their pricing has never really been quite where it needs to be to attract lots of new mortgage loans. They've recently got a new funding line from a different investment bank in the city, and actually this has dropped their pricing down. So CH are actually pricing incredibly well at the moment. So if you are looking for a more specialist mortgage, so large portfolios, limited companies, you know the kind of stuff I'm talking about, these guys are actually someone that might price up very, very well, and you might see their names come up more often. Vida Home Loans also had their rates drop down by 0.4%. Vida, another specialist lender. And then lastly, we've seen Virgin Money bring their rates down by up to 0.07. Virgin, the antithesis of all the people we've just spoken about. So individuals, no HMOs, no multi-units, max of 10 properties in the background. But they've also got some really nice bits of lending criteria. They're one of the very few clearing banks who can do a remortgage inside of 6 months against open market value. They're also quite good at some of the quirkier property types, so things like debt access would be one for them. So in the short, some interesting repricing from lenders, nothing to get excited about, but also nothing to panic about. I think when we see swap rates go up, all of us at MFB are kind of thinking, oh goodness, what does this mean in terms of mortgage rates? But actually things are kind of staying nice and steady, which is a good place to be. Okay, so first exciting piece of lending criteria change that we've had in the last week is that Foundation Home Loans have now entered the 85% loan to value lending market. So what they've done is they've launched some 5-year fixed rates at 85% loan to value. They were previously capped at a lower loan to value. What they tell us is that their range is available 85% to individuals and limited companies. It has no product fee, and your pricing here is from 6.49%. It's available for loans of £100,000 and above. Now, Foundation are an interesting lender. They're a specialist lender. They have really, actually, in fairness to them, really kind of thought very hard about how they can serve the landlord market. And so by doing so, they have introduced all kinds of different kind of veins to their lending propositions. So things like holiday lets, expats. They can also consider slightly more quirky things. They've got a sort of product range for people with slightly imperfect credit profiles. They've also started doing semi-commercial. So they're really trying to sort of, look at every type of investment asset class, but also different types of borrowers, and trying to accommodate everybody where they possibly can. So 85% loan to value lending is really just another string to their bow. Now, in terms of is this unique in the marketplace, and I did actually check, because we don't get a lot of 85% loan to value inquiries these days. We used to, back in the day, people always wanted to borrow the very maximum they could, but actually nowadays 85% isn't really something a lot of borrowers ask for. Most of you are sort of 75, maybe 80 at a push, particularly for high yielding assets, so HMOs, for example. But there are actually other lenders lending 85% loan to value, namely Vida Home Loans and Molo. What I would say is that Foundation, with the rate and then no arrangement fee, are actually pricing incredibly competitively in that particular space. So really good to see a lender, I guess, look at their criteria, see how they can kind of improve on that to serve the landlord market. But also, just a kind of sort of secondary point to this is that actually when a lender increases their loan to value, so going up to 85%, it's pretty punchy because there just aren't that many lenders in that space. What that could also tell you is that the economists in Foundation Home Loans, or whoever it is, their advisors, are feeling pretty kind of comfortable that the property market isn't going to be going down anytime soon. Okay, now BM Solutions has gone into limited company lending, which I love, only because when we had the Section 24 announcement years and years ago, I remember having a chat with someone from BM Solutions and I was saying, oh, do you think you're going to limited company lending? And they said, no, I don't think it's going to be that big a deal. And now they're doing it because obviously, God, what, 10 years later or something, they've realised that it is a big deal. And actually, around 85% of investors are now using limited companies as their preferred investment vehicle for acquiring buy-to-lets. So welcome to the limited company lending arena, BM Solutions. Good to have you on board. And what we're seeing, which is very interesting, is kind of what we would have said previously is that the limited company market was really lent to and serviced by specialist lenders, and then we had the more vanilla lenders who are lending to individuals. What we're now seeing is that within what we would call specialist lending, i.e. limited company lending, we've got vanilla lenders and specialist lenders, and you're going to see a sort of notable split in the limited company market on the same sort of vein. So for the sort of vanilla lenders, we have people like the Leeds, the Mortgage Works, and BM Solutions has now come to the table as well. Whereas in the more specialist lenders, you've got people like Kent Reliance, Foundation Home Loans, Keystone, Paragon, Fleet, and so the list goes on. So what you're going to see there, in the same way that we saw a split in pricing before the vanilla lenders came to the sort of specialist table and stuck their toe in, is that there is a notable difference in pricing. You have the vanilla lenders who do a bit of limited company lending, cheaper pricing generally speaking, and then you have the specialist lenders who do limited company lending. Their criteria is much broader, and we're going to go into the criteria of BM Solutions in a moment and you'll see what I mean. Their criteria is much broader, and also they're able to kind of lend on more quirky things. So for example, your HMOs, multi-units, and all that kind of stuff. So looking at the BM Solutions criteria, and I wanted to just dig into this a little bit because it's actually really interesting. Stuff that is kind of, I guess, second nature to me. I've actually just kind of thought about it and realised it's probably, for those of you who haven't yet got into limited company lending or have and are kind of really interested in what lenders are looking for, this could be kind of a really useful bit of information. So in terms of BM Solutions lending policy, so first of all, in terms of company structures, so the first thing they say is that they would accept recently formed limited companies, and they must be registered on Companies House before an application is made. So this is actually very standard. So what they're essentially saying is we don't mind how old the company is, but before you can make an application, you have to have the company in place. That is standard for everyone. How on earth can you make a good application for a limited company when the company doesn't exist? That's the first thing. SIC codes, very, very standard requirements here, 68208, 68100, 68320 and 68201. They're their kind of standard SIC codes. If you want to know more about SIC codes and what they're actually all about, give me a shout, I can talk you through it. But essentially these are the codes they're looking for. If you have any other SIC code on your company, they're going to decline it because that would tell them that your company in their eyes is not an SPV. Trading or layered companies are not accepted, and this is where we start to see the split between the vanilla and the specialist lenders here. So a trading company is a company that does rentals and something else. Doesn't matter what it is. Even if you are a property management business, that would sort of fall foul of the requirements of an SPV. An SPV can literally only hold rental properties. So there are companies out there who can enter trading companies. As an example of that, we've got Keystone, where we've got TML and Aldermore. Now, layered companies is where you have a company that's owned by a company that's owned by people. I mean, you can go beyond that, company owned by company owned by company, you can go on forever, but the point being that the immediate shareholders are not people. So with all the vanilla lenders, and BM Solutions fall within this, they literally want a company that's owned by people. The shareholders have to be people. So there you go. They also go on to say that partnerships and LLPs are not accepted, so it has to be a straightforward limited company. Floating charges and debentures cannot be in place over the company. Now, this is a real biggie that actually is becoming a bit of a stumbling block for us, and we've come across this a few times with some of our clients. So back in the day, lenders always used to take a charge over the limited company when they lent to the company. Why would they do this? Because if actually things started going wrong and the borrower wasn't paying the mortgage, What it meant is they could step in, take control of the company, therefore take control of receipt of the rents, and they could really start to manage things themselves. There are still some lenders who do take a debenture over the company which they're lending to, but this number has kind of really fallen away. So for example, Paragon used to take a debenture, they don't anymore. So there's a lot of people out there who have limited companies, and these companies have debentures, so mortgages secured, or the lender has taken a charge over the company, I should say. And because this was done quite a long time ago, the borrowers, the actual people behind the company, don't necessarily know that they're in place. Now, some of the newer lenders that are coming to the table with their lovely, shiny, lower interest rates, so BM Solutions Coventry would be another really good example of this. These guys will not lend if there is a debenture in place already. So one of the things that we need to start getting really good at asking you guys, and you need to be good at checking and speaking to your broker about, is if you have got a debenture in place over your company at the point of application, you need to tell your broker, because that will determine which lender will lend to you. Okay, now next one, companies must be registered in England, Wales or Scotland. We're not having Northern Ireland here. Directors and shareholders, so maximum 4 parties to the company who must own 100% of the company between them. So what they're essentially saying is you can have up to a mixture of 4 directors and shareholders, but these have to be all of the people involved in the company. This is really complicated because lots of different lenders have very different rules about this, in terms of there have to be a certain number of people who own X number of shares, and some lenders only take PGs from the directors, they don't care about the shareholders, and it's really, really complex. But if you want to take a mortgage with BM Solutions, or actually most of the kind of vanilla lenders, the more competitively priced lenders, then just know that actually you can have no more than 4 people involved in the business, and they must be the directors and the shareholders, and they're going to have to all be willing to stand and give personal guarantees and be underwritten. What they say here is, I don't really understand this one, more than one company can be financed with BM Solutions. I guess that means that if you've got one company, you can also have another company that gets a mortgage with them separately. Directors and shareholders must reside in England, Wales or Scotland, very standard criteria. What we don't want is people, well, we talked about this lots of times, you can have expats, but actually your very vanilla lenders aren't going to lend when there's an expat involved. I don't know why we're not including Northern Ireland in that, but BM seem to have something against Northern Ireland here. Personal guarantees for the whole loan amount will be taken from all director shareholders. So what you can't do is say, well, Jenny only has a 10% share in the company, so she doesn't want to give a personal guarantee, or she'll give a personal guarantee, but only for 10% of the loan. That's not going to happen. Everyone has to give a full personal guarantee for the whole loan amount. Again, that is very, very standard lending criteria across the limited company lenders. Independent legal advice will be required for each personal guarantee. Now, this is a bit of a bone of contention. So independent legal advice is asked for by most limited company lenders. And what this is essentially each individual person who's providing a personal guarantee has to go to a solicitor, and they will run through the document that you're going to be signing to say that you've had legal advice. Why do they want you to have legal advice? Because it's really important that you understand that when you sign this personal guarantee, there are implications for you, financial implications. And in times gone by, it might have been that certain people had gone to court when a lender had called on their personal guarantee and said, well, I signed it, but I didn't understand what it was, and it became unenforceable. So these days, lenders are taking a belt and braces approach to personal guarantees, and they're saying, look, actually, you need to go to a solicitor, and they're going to run through the ILA document and tell you exactly what you're signing and what the implications could be for you. So there's no kind of get out of jail card if I didn't know what it was, gov, in the future. The problem with ILA is that it's not cheap to do. So if every person has to go for it and you've got 4 of you in an application, you could be running up literally hundreds of pounds worth of legal costs. Now, we have access to some legal people who are actually able to do ILA quite cheaply. So if you do need to get ILA and you're finding that your sister's sort of quoting you 400 or 500 quid, which is what I paid for mine when I did mine years ago, incidentally, actually it's probably worth giving us a call, because we can probably get you someone who's going to save you some money there. But back to the lending criteria, yes, ILA is going to be required with BM Solutions for all of the borrowers. What else can I tell you about the criteria that's interesting? The company must seek approval ahead of making any changes to the company. So once you've got the mortgage, if you're going to start messing around with directors and shareholders, you need to get approval from BM Solutions. You can't just do it and think the lender's not going to know that you've done it. They do get notifications, or most of them do have systems in place which ping them when a change is made at company's house. So the best thing to do is that you're going to ask for permission rather than forgiveness on this, and get the permission before you make any changes. In terms of more broader criteria now for BM Solutions and a limited company offering, they can do purchases and remortgages. The rental calculation will be 125% coverage, very, very standard stuff. Maximum 75% loan to value. Properties they're lending it in England, Wales and Scotland. Currently, they're not offering further advances, so if you take a mortgage with them on a 5-year fixed rate for 5 years, as it stands at the moment, they're not going to give you any top-up mortgages. They will be offering product transfers in due course. So in 2 years' time, when their first limited company loans start to mature, they will be offering you something to stay with them, which is really good. They're actually very good at product transfers, BM Solutions, so I'm pleased they're kind of saying they're going to do this openly at this moment in time. Last thing on criteria, which we do come across as a bit of a sticking point for some people, is deposit money and how this is formed. So directors' loan deposits are fine. So that would be essentially, I am Jeni, I'm lending my limited company money as a director's loan, as a deposit for my new purchase. That's really, really standard. Every lender accepts those. Must have a limited company bank account for direct debits and fee payments. That's really standard. You have to have a limited company bank account. For those of you who are thinking about going this, do your research. They're not all free. And every transaction you make, you get charged for. They also are saying on deposits that intercompany loans are not acceptable. So this is where it might be that I'm a dentist, I have a dental practice, and this has got an amount of money in it that I then want to use to buy a buy-to-let. That company cannot lend my SPV the money to go and make my purchase. I'd have to withdraw that money from the company into my own name, pay tax on it if that's the kind of situation I'm in, and then re-lend it to my SPV. That is a standard requirement, but not every lender has that same requirement. So again, if you're looking to do that kind of structure, let us know, we'll be able to help you out with that one. And I think that really kind of wraps up in terms of the criteria, but I thought that'd be useful just to go through different things they're sort of saying and how that sits in the market and something to be aware of. In terms of pricing, and this is the thing you guys are really interested in, I would imagine, rates are from 3.99% with a 3% fee, so pretty decent pricing there from BM. Okay, now just a bit on the housing market. Interesting for those of you who are looking to sell, and also for those of you who are thinking about buying and trying to pick your moment in terms of when is a good time to do it. So at the moment, we know the housing market is really, really slow. If you're trying to sell something, it's an absolute nightmare, nothing's selling. If you're looking to buy something, then you can really go and negotiate relatively hard on prices at the moment. However, you'll also find that people are being quite strong in terms of their price expectations. This is kind of causing things to almost reach a stalemate. And so properties just aren't really moving that much at the moment. So there was a bit of data revealed, or released rather, don't reveal it, they just share it, from the Bank of England this week, which showed that the British people's borrowing of mortgages and consumer credit rose at a faster pace in June. So what these statistics released by the bank show is that the net borrowing of mortgage debt increased by £3.1 billion in June, and borrowing of consumer credit grew by some £500 million compared to the previous month. Remortgage approvals also hit their highest level since October 2022. So what does this all mean? So there's a chap called Lucian Cook, who's the head of residential research at Savills, and they said the rise did not indicate the housing market was back on its feet again. But what they do say is they're anticipating that mortgage buyer demand will pick up gradually heading into early autumn. However, for momentum to truly build, households must feel more confident, not only in their personal finances, but also in the broader economic environment. So let's just dig into that for one moment. So essentially what we're seeing is actually, as mortgage rates are starting to soften, and also there's this whole thing that you guys may have seen talked about, which is a relaxing on how much you can borrow on residential mortgages compared to your income. That's going to really sort of start to kind of kickstart the housing market once more. And that's why people are saying, actually, right now, we're not in like full-on recovery mode, but we're starting to see the grass shoots of that. And so actually, come the autumn, things will be feeling a lot busier in the housing market. Now, Capital Economics, a UK economist Ashley Webb said the rise in mortgage approval showed the recovery in the housing market after a post-stamp duty decline was well underway, though the 7.8 billion rise in bank deposits among households suggests Brits were in the mood to save rather than to spend. So this is an interesting one as well. So at the moment, people seem to be very diligently saving their money. However, conversely, we've also seen mortgage approvals and consumer borrowing had also increased. So I think it feels like we're kind of on the cusp. What does this mean for all of us ultimately? What's the kind of so what in all of this? So I think what we're really hearing here is that actually the data is revealing that people have been screwing lots of money away. We know the housing market has been very, very sluggish, and we're also starting to see the number of mortgage approvals rise. We knew this would happen. People have been waiting for interest rates to come down. They're waiting for house prices to kind of steady. It feels like we're at that kind of point now. And I think once we get the Bank of England meeting in August out of the way, people aren't really expecting further rate cuts this year. If the August rate cut doesn't happen, and I suspect maybe people will then be hanging on for it to happen later on in the year, but assuming it happens in August, then we're kind of done. And I think then what we're going to see is a real kind of move and see the market really start to pick up again. So if you are thinking about selling, or like me, you're trying to sell, possibly worth putting the property off the market and relisting it in the autumn, or like just riding it out. And alternatively, if you're thinking about buying, just keep in mind that things could be about to get going again. Never a dull week, is there? I hope that's been helpful. It's proving quite lengthy actually for a week where I didn't think there was going to be much to say at all, but informative at the same time. If you have any questions, do give us a call at 345-345-6788, and do sign up for our webinar that's happening on auction purchases. We have a chap from Auction House coming in to speak to us. He is amazing. Auction House is the largest auction house in the UK now, so they come with absolutely loads of experience and advice for you. And actually, I think auction purchasing, while people, my generation, have often shied away from auction purchases because we sort of see it as really scary and where only kind of rubbish, cheap property is sold. That is not how it works these days. So actually, I think what we're going to see is that auction purchasing becomes almost, in years to come in the future, a very normal way of acquiring property in the UK, and possibly will become the main way people acquire and sell property in the UK in years to come. So definitely worth having a watch. There you go. Have a fantastic week. I'll see you same time again next week.